Hi, good afternoon, everyone. My name is Ramendra Bhatia, and on behalf of ASK Investment Managers, I welcome you all to ASK Specialized Portfolios quarterly update call. Today, we have with us Mr. Gagan Thareja. Mr. Gagan Thareja, Portfolio Manager, has work experience of more than 18 years in equity markets. For 5.5 years, he was with Kotak in their investment team for their alternative investment fund in listed equities. Prior to that, he was associated with the investment team at Comgest India Advisors, Indian Advisory to Comgest, a Paris-based AMC for 4 years. Before joining Comgest, he worked with Batliwala and Karani Securities for 7 years as an equity analyst. Gagan has a postgraduate degree in finance from Department of Financial Studies, Delhi University. Gagan joined ASK in September 2021. Today, we have scheduled this webinar wherein I would request Gagan to cover the broader trends in the market for 10-15 minutes, followed by deeper understanding of the ASK specialized portfolio, giving an insight on what happened till now in FY25, where do we stand now, and how we see things going forward. This would be followed by Q&A. I would request all of you to type in your questions and queries related to the portfolio, and we shall curate and try to get them answered. So Gagan, thank you so much for joining in, and all over to you.
Yeah, thanks, Ravinder, and good evening, everyone, and welcome to the webinar. I'll start with a brief presentation, and I'll run through the slides quickly so that we have time for Q&A. Yeah, so we are all fairly conversant with the recent developments macroeconomically speaking, but nonetheless, I'll just run through what I consider is relevant for equity investments. Right up to the election outcomes and the government formation, there was volatility in the market. Clearly, because the run-up in the market thus far had been driven by very strong government investments, and therefore themes associated with investments were the ones that drove the rally. And while there was initially a mood of uncertainty because a coalition government was coming in, and you could see a certain amount of movement towards the consumption segment, given the fact that the government might have to reallocate a certain amount of their finances, possibly to that segment. But thereafter again, the investment teams seem to have come back fairly strongly. Associated and events for the stock markets are the onset of monsoon, which has been on schedule and on time, and there are predictions of a rainfall which will be better than the long-term averages, and consequently, you can see some of the agro themes also subsequently picking up. Associated with that is the question of rural incomes, which so far have been impacted by inflation. So rural wages, rural wages are inflation-adjusted. Rural wages have taken a hit over the last few years, and rural balance sheets have also taken a hit because of 3 or 4 debacles back to back in the last 4-5 years. And there's a view that that might also change for the better. There are some data points which perhaps point towards that direction. An uptick in two-wheeler sales, increase in cable and wire sales in the rural and semi-urban segment, and commentary from rural-focused consumption companies like Imami generally seem to point out that on the margin things have improved, and perhaps 25 will be a better year for them than 24. So policy continuity in place with the government by and large with the same set of ministers within the critical ministries coming back. And corporate performance 24 has been very decent. Nifty earnings growth of 26%. Macroeconomically, everything seems fairly sound. So that's the macro backdrop in which we move into FY25. Specifically for Q4, more of the same of what we saw in the previous 3 quarters. The cyclical themes related to infrastructure, capex, BFSI playing out well, and challenges remaining in the FMCG and IT segments. And moving forward, we've already discussed. Agriculture and capex are perhaps the two in the short run, perhaps the two positive themes. I would also venture to make a statement that some of the commentary that you get from IT companies based out of US is also on the positive side with a lot of improvement in cloud-based investment. So perhaps a recovery in the IT segment is also in the offing, but a gradual one, because part of it is also dependent upon IT budgets, which and BFSI being a critical segment because it's 1/3 on an average of the Indian IT companies, is still somewhat under pressure. They are big, at least the community banks in US are big lenders to commercial real estate, and that's a segment which is still very weak there. So perhaps a recovery, but a gradual one in the offing in that space. Macroeconomically, the geopolitical tensions still persist. The latest issues are around logistics on the Red Sea corridor, and that has increased freight and logistic costs for companies which are export dependent or import dependent. Nifty earnings, at least the consensus estimates seem to indicate towards moderation at 15% growth for the coming 2 years. This one gives you some idea of the domestic institutional flow, a very strong SIP book, which remains at 20,000 crores a month, and which still seemingly supports the markets, albeit at valuations which perhaps might seem a little stretched. The earnings trajectory, as I indicated, Nifty earnings 15% CAGR for the coming 2 years. From a valuation perspective, Nifty valuations now are reasonable from a 10-year perspective. Coming on to the fund, the ensuing slides will give you some flavor of the constitution of the fund. So this one is a market cap classification of the fund. You can see 45% in mid and small caps and 55% in large caps is how the investment breaks down. This is a sectoral exposure of the fund. You can see engineering and industrial consumables and ports put together are almost 1/3. So we've sort of indexed ourselves to the infrastructure capex theme, and the evidence there still remains very strong and healthy, and we'll continue there. Healthcare we've added to our basket, and we'll discuss that in a while. This gives you an evolution of the portfolio construct over a period of time, and you can clearly see infrastructure and engineering as the salience of this particular segment's been increasing in the portfolio from almost a quarter to right up to almost 40% odd. Some of the stock actions that we undertook in the bygone quarter. So we've added Polymedicure, which is a medical devices company. Almost 65 to 68% of its sales come from what's called an IV cannula, which are used heavily in hospitals in cardiac surgeries and also for intravenous medication kits. That's their mainstay product, but then they've also gotten into dialysis machines and dialyzers. They've also started a critical care equipment unit, and recently also gotten the US FDA approval. So to give you some idea, this is a company with 2/3 of its sales coming from exports. EU is very big for them. 40% of their sales is in EU. And they've grown very well there. If you track the history of this company, a very consistent 20% plus sort of top line growth and margins in the corridor of 25%. Medical grade plastics is their input, which they have to buy out from China. So that's one element of risk for them. Obviously, the prices move basis the crude price movement. They've doubled their capacity fairly recently. And they seem to continue to guide for a almost 22 to 25% top line growth. And as the new capacity gets utilized over the coming 2 years or 3 years, there's scope for some margin improvement through operating leverage. In addition, as I said, they've recently got US FDA approvals for some of their products, and a scale up there would come at better margins. Given the economics in the US market. So all in all, a continuation of strong mid-20s growth here. They'll also benefit from the PLI schemes because their dialysis machines and dialyzers are products which will benefit from the PLI scheme. They've scaled up well in the last 2 years since starting off. And more importantly, I think the new medical devices policy in India will also aid their cause because it standardizes and aligns the Indian medical devices quality regime to the global ones. So far, the entry barriers for imports from China were low. Now, Chinese equipment will require registration. So also will equipment from small and medium enterprises. Which basically means that market share will move towards companies which already have quality registered products, which is possibly going to be a source for Polymedicure to increase market share in the Indian market. And they've also come out with a broader basket. And that was, the underlying investment thesis for getting into Polymedicure. Adani Ports and SEZ we've already discussed in the past. This is an investment we've already made in the quarter. 420 million tons of load being pushed through the ports. They are by far the largest in both container and non-container freight. 27% market share overall and 40% market share in container load. They've in their annual report they've come out with a very strong 5-year plan of taking this port handling from 420 million tons to almost 1,000 million tons going into 2030. In the short run from 24 to 25, 420 goes up to 500. So clearly, an early to mid-teens volume growth is there for Adani Ports in the coming 5 years. They've over the last few years consistently brought down leverage, and which is now fairly comfortable. And they intend to remain, in this corridor of 2 to 3 debt to EBITDA. So a consistent, predictable sort of growth with less volatility around it, and therefore, a fairly interesting investment theme for us. The third one is BHEL. The underlying thesis in BHEL is predicated on coal-based power generation capacity additions in India, which are the plan is to increase coal-based capacity by almost 90 gigawatt for the coming 10 years. This is now a space with fairly limited competition. BHEL and L&T are perhaps the only two companies with active boiler turbine generator capacities. L&T having almost 4,000 megawatt and BHEL having 13,500 megawatt of capacity. So by default, the company with the largest market share, you would have seen in the recent past a spate of 800 megawatt supercritical orders being given out and coming BHEL's way. They talk of almost 10 gigawatt of ordering pipeline annually here on for the next 5-6 years. At around 5,000 megawatts of power related orders, they tend to break even, and they are now at a juncture where they'll be executing north of that. So not only strong order inflow, but this will come with an inflection in margins as the fixed cost recovery tends to improve. Their other businesses is in the industrial space, where they provide associated equipment to the power segment, which is pumps and compressors and valves, not only to the power segment, but also to the oil and gas segment. And they also supply naval guns and related equipment in the defense space. And of late, they are also, in the industrial space through railways, where they've tied up with Titagarh and will be supplying train sets for, the Vande Bharat trains. A company which is playing the investment theme through all the three areas which are seeing a strong demand uptick, which is power, defense, and railways. And therefore, and the visibility is there for the long haul. So, that is why we thought it would make a good addition to the portfolio. The exits were Dalmia Bharat, while again a theme in the investment in the infrastructure space and the capex space with a very strong capacity addition coming on stream. We thought their execution was a tad poor and lagged. In East, they tried to shake up the market, to get the pricing to improve a little better, and in that effort, they lost out market share. So it will take some time for them to come back and recoup that. And we thought that it would be better to, play the investment theme through a more visible and a more strong sort of area of investment, and that is where you'll find the shift away from Dalmia Bharat and into BHEL and Adani Ports. While we are at it, I'll also mention that we have exited our position in Bharat Electronics, which was our defense investment in the portfolio. We made very reasonable returns on that one. And while the theme remains very strong, the valuations, I think, were fairly stretched. While momentum remains, and we've seen after the election results that theme has bounced back. We thought it fit to exit at that price. And also from a risk perspective, we found it better to add to our investments in the healthcare space. So this gives you some flavor of the outcomes, corporate outcomes of the portfolio versus the Nifty. You can see the portfolio profits for the quarter have grown healthily and ahead of the Nifty 50. Likewise for the year. And for the coming 2 years, the Nifty CAGR, as I indicated, was 15% for earnings, and our portfolio CAGR is ahead of that. And that is the fundamental premise for us to look for in a concentrated portfolio, which is that consistently good and healthy earnings growth ahead of Nifty is where we should be positioning ourselves. And this gives you some flavor of the portfolio financial efficiency, the ROE, ROC metrics of our holdings in aggregate, weighted average, and the valuations also. The valuations remain slightly ahead of Nifty, but then I would suggest that that's a bit in line with the higher portfolio growth as well. And this one gives you, the direct track record of the fund right through from inception to year to date. We are tracking ahead of the index year to date, and I hope we can continue to maintain, the spreads that we've so far been able to generate. Yeah, that I think is all from my side, and we can get into a Q&A now.
Okay, I would request participants to type in your questions and queries related to the portfolio, and we shall curate and try to get them answered. Gagan, there is a lot of interest building up with multiple questions already been raised. So first question comes, it's like, what are the key themes you are covering under the specialized strategy?
So, I mean, there is an underlying investment thesis which is centered around, market size, capital allocation, and the promoter skin in the game. That is what we keep in sight all the time. As far as themes go, the idea is simply to capitalize on where we see growth happening in a sustainably strong way over multiple years, and that is where we have gravitated. You can see, we are trying to play the infrastructure theme. Clearly, there will be continuity there. And while we will remain invested in that theme, we will continuously appraise ourselves of the valuations. And if we believe that the price value gap narrows down or is unfavorable, we'll reposition ourselves while maintaining our allocation in the theme. And from a risk perspective and a growth perspective, we'll keep on adding in other themes. So as I indicated, we've added to the healthcare space, albeit not through pharmaceuticals, but through medical devices, which I think is a sustainably long-term theme, given both the policy changes and you can also see how the hospital bed growth in India is happening, and the insurance growth is happening. So all the inputs which you require for this space to grow are in the making, and so our allocation to those counters.
Okay. The next question is your view on the consumption focus sectors volume growth, which is low for quite some time now.
Yeah, so it has been low, and as we discussed at the start of the webinar, I think it is down to the rural balance sheets taking a hit and rural wages, inflation-adjusted rural wages not really growing. I think that's a situation that is perhaps turning. I mean, at least the evidence coming from the corporates would suggest that there is some sort of recovery underway there. And if this agriculture season passes off well, it might lead to improvement. there is a certain amount of consumption which you can defer, perhaps not, eliminate by completely. So consumer durables of a small to medium ticket size should see a pickup. I mean, if you are already seeing a pickup in two-wheelers, which are in a way rural centric, I would think that there should be a reasonable rural recovery going ahead in the next 2-3 years. The point is, how should we think or play through this sort of a recovery? FMCG will perhaps be a moderate recovery to mid-teen or to mid-single digit sort of a volume growth number, which we've seen in the past. Perhaps the recovery might be stronger in consumer durable products. So consumer electrical and electronic appliances or kitchenware. Consumer retail, rural retail could perhaps be another way to look at it. Apparel and footwear retail have been rather weak in the last 2-3 years. Perhaps that's a space which will see a recovery. So I mean, we'll keep a watch out for these spaces, and if need be, we'll reallocate to some of these themes.
Okay. The next question is, how are you taking PSU as a segment at this current juncture? And is there any strategy to capture the growth of this sector in your portfolio, direct or indirect exposure?
So we already have direct exposure to PSUs. You can see the portfolio. We have 3 PSU entities. We in fact had 4, and one of them we liquidated. So we have a direct exposure to the PSU theme. And in any case, I mean, we have indirect exposure too, because as I indicated, not only power generation, but power transmission is also a strong theme, especially related to power. If you read the commentary of companies which are in that space, transformers or drill, or companies like Hitachi Energy, there's clearly positive momentum in that space, and we play that space through our investments in KEI and Polycab. So we have direct and indirect exposure to themes associated with PSUs.
Okay. Next question is regarding Navin Fluorine International. We have seen underperformance of Navin Fluorine, which is a leading player in refrigerant gases for long period of time. There is a new appointment of CEO. Also, they are having capex plans. Is there any acceleration expected in revenue from H2 current financial year? Yeah.
Yes. So, more than that, I mean, let's put it this way: Navin has had a perfect storm in FY24. Refrigerant prices, for that matter, broadly, chemical prices have been under severe pressure. Navin has an exposure to pharmaceutical and agriculture segment in a reasonably large way, and agricultural chemicals or agrochemicals as a space have seen very severe price erosion right through the last financial year, and also seen volume drops because of the high channel inventories. So if you go through the commentary of ag chem companies, domestically things seem to be already on the mend. Globally, perhaps it will take 2 more quarters before the volumes recover back. The prices have stabilized now. So apart from that, Navin also had teething issues in their HFO plant, so they couldn't scale it up on schedule last year. And added to that, as you indicated, there were senior management exits. So as far as I can understand, the HFO plant is back online. The scale up has already happened there, and so it will benefit them for the whole of next year. The refrigerant space, the prices have stabilized out, and the demand is fairly strong. Volumetric demand is fairly strong. their MPP plants, they've added new chemicals post-validation, and so there'll be a scale up there. Their most profitable business, which is the CDMO business, which saw a very sharp drop down this year, will recover, but recover only, I think, towards the second half of next year, because they are undertaking validation batches for new molecules, which will, if all goes well, come on stream only towards the second half of next year. So it'll be a year of recovery for them. But a full-blooded recovery will probably be in the second half of next year.
Okay, the next query is on Syrma SGS Technology. In spite of revenue increase 60% quarter on quarter and 67% Y on Y at 1143 crore, Syrma SGS Technology stock hasn't done well in the recent past. Your views on the same?
So again, for Syrma, I think it's a combination of two or three things. One, they've doubled capacity this year, which is obviously still to be utilized. They've added a lot of senior people in the management team for their verticals. That is perhaps not a recurring cost. They've also added certain clients which will eventually be high volume clients, but in the initial phase, the ramp up will take a certain amount of time. They will have to get their certifications in place. So, and they've also, I think, hired McKinsey for an operational rejig. So I think this was a year where those costs anchored down their profitability. Apart from the fact that the sales mix shifted, towards the consumer segment, which comes with relatively higher volumes but relatively lower gross margins, and their indication is that in FY25, as operating leverage plays out and volumes ramp up, there will be some margin improvement, and the large clients, when the contract is in full spate, will come at relatively better working capital terms. So I think the two areas of concern, at least per management's guidance, should improve in the coming year. Growth is not a concern for them. They have a long runway of growth available. And we'll closely monitor the company on these two aspects. And if the turnaround happens, the investment theme remains and is consistent. Otherwise, we'll reconsider and see what needs to be done.
Okay. Meanwhile, I would request participant, in case you have question, you can type the question. We shall curate and try to get them answered. The next question is on your outlook, Gagan, on Polycab and APL Apollo. APL Apollo, since in the shorter term, stock is not doing well.
Yeah, so I mean, if you look at the company's track record, across of half a decade or more, it's a very consistently well-performing company. Yeah, last year the volume growth was a bit of a struggle for them, and I think part of it is coming from a delayed ramp up of their Raipur facility. Part of it is coming up from a relatively weak demand in last year. If you sort of try to connect the dots, this is a product which goes in construction activity in a big way. So commercial construction, infrastructure construction, and ideally these are areas where investments are headed. And in addition to that, their product basket is improving. Value-added products are rising. So the theme remains strong. Their guidance for the next 3 years is 25% volume growth, and it's a management which we think is a credible one, and we would like to continue believing them. And therefore, I think it's a company with strong growth prospects for the next 3 to 5 year time frame. So we remain invested. And I mean, we'll as we indicated in the past, keep on appraising quarter by quarter, whether the demand actually plays out as guided or not. But as things stand, the commentary seems very strong from their side. And as far as Polycab is concerned, if you go through the commentary of the cable and wire companies, there's generally an indication that given the investment themes that are in place, a 15% market growth is very much in the offing for the next 3 years. If the market growth itself is going to be 15%, Polycab, is the largest company in the space with the best distribution network, with the best product basket. Irrespective of whether they take share or not, they can still grow at market rates. And I think they have some margin levers on their consumer appliances side, which they're making an effort to turn around. So again, a company positioned strongly in the infrastructure theme. Additionally, I think apart from the domestic telecom and electricity themes, they are also now certified in some very large geographies for exports, which I think should pick up, already picked up strongly and should pick up further in the coming years. So we again feel that a healthy growth thesis is there. They've always been capital efficient, so the business economics is not something that worries us at all. So we'll remain invested in the theme and the stock.
Okay, so there are no more questions. In fact, we would like to thank everyone for their kind attention and participation in ASK Specialized Portfolio's quarterly update call. Thanks, Gagan, for sharing the quarterly update. And
thanks for your time.
Yeah, this concludes our call. Thanks all once again. Thank you so much.